everybody for attending our Helm masterclass here. Typically our masterclasses are a little more geared directly to professionals. This one's going to be a little bit different. It's going to be geared not just to professionals like accountants and bookkeepers, but also to business owners directly and talking to them about different things that they can do, what cash management is, and all that kind of fun stuff, and how it can essentially help you make ultimately more confident business decisions in your business. So thank you for attending. A few housekeeping rules just to start it off. If you have any questions for us, please use the Q&A. At the end of this session, we'll have an open Q&A session where you can ask whatever you want. But for the time being as we go, if you have any questions, please put them in the Q&A and we can either answer them as we go via text, or we can just leave them until the end and talk about them as a group. Please mute your phones and close your emails. Let's use this time to focus and have a good interactive session. And in that regard, this session is not going to be recorded. Sometimes we do record them. This one is not, but we will send you some of these slides afterwards. Laura, did we have a poll here? I'm going to say yes. So, question for everybody out there. What are you currently using for cash flow forecasting? The question probably says cash flow for, but it really was supposed to be cash flow forecasting. So I'll just give a little bit of time there for people to kind of log their answers, and we'll go from there. So we'll say that's good. I'm ending the poll here and I'll share the results. So as is common, most people are actually using spreadsheets. That is very common in terms of cash flow forecasting and cash management. We've got one Helm user, which is great. So thank you. And we do have a couple other people using different apps. So this will be kind of relevant for everybody across the board, even the people that are not using anything for cash flow forecasting right now. So again, this is more of a educational content, so it's just kind of good to know what is what. Did I share those results, or am I getting?
Yeah, they were shared. Yep.
Okay, so then I'll just close mine here. Okay. So moving on here, what you'll learn today is a little bit about why cash management specifically is important. And talk about opportunities to save money, as well as opportunities to save time. And we will also go through context. And what we mean by context there is, as part of cash flow forecasting and cash management, having conversations with all the related parties in the process is really key. And it's often forgotten in terms of the entire process. Context is really key. It's one of the reasons that, in our opinions, cash flow forecasting and cash management really can't be 100% automated ever through AI or other tools. It's because you can't automate what's in your brain. So all that being said, I'll kind of start out talking about myself, because hey, who doesn't like doing that? I started a firm here in Calgary, Alberta, Canada in 2014, so around 8 years ago. That firm really specialized in helping small businesses. So, what I would define as businesses anywhere from $300,000 in annual revenue all the way up to $5 million. And we really wanted to help these people because they work really hard on their services and their widgets. But where I really saw them kind of falling down was on the financial side. Their bookkeeping wasn't up to speed. They weren't compliant on taxes. And they truly needed help with financing and budgeting and forecasting. And what we really found over time as we grew our firm was that there was really a large market for the budgeting and cash flow forecasting and future looking information. Everybody did need the compliance and the tax, but what they were really interested in was the cash flow forecasting specifically. Everybody had questions around, how am I going to pay my debts? How can I make my payroll? How can I expand operations and manage everything in one time? And so, these are optics around the next 0 to 12 months. We were also, in the CFO space, fractional CFO space, and we build out models 3 to 5 years. And those were fine, but where people really needed the help, at least where we found, was in that 0 to 12 month range, actually executing, their strategies and their plans, and reacting to changes in the business environment as it went along. And so, of course, we started out like most people do. We started using a lot of spreadsheets, and spreadsheets are painfully hard to use in terms of cash flow forecasting and cash management. They take a lot of time, especially when it comes to the communication piece and just the general decision-making planning piece. They're great for customization and setting up, but they fall apart on a lot of different other levels. And so we started looking out for other apps in the space, and we just didn't find apps that we thought really served our needs. We needed something that we could decision off of quite quickly, and something that was very simple and easy to use, especially given the dynamic, iterative nature of short-term cash flow. So that's why we built Helm. Ultimately, we wanted to solve our own pain point. And so we built out Helm as that tool. And, we still use it to this day in 2080, and it helps us with our cash flow advisory process. So, we offer it to other firms as well as to small businesses themselves. So let's actually get into learning a bit as opposed to talking all about me. And let's start out by talking about why profitable businesses fail. Statistically speaking, when you look at business failure rates, 80%, people have probably heard this, 80% of all businesses fail over a 10-year time horizon, and 80% of those businesses typically fail due to cash flow issues. What a lot of people don't know is that 60% of those business failures are actually profitable. And so profitable businesses do fail. It's actually really an issue. So let's break that down a bit, because it's pretty useful. If we look at profit at a very simple level is simply your revenue less your expenses. And so profitable businesses have more revenue than they do expenses. And this means that as they operate, they should be bringing in more cash than they are spending. But of course, if that's the case, then how can profitable business fail? And that's because when you really look at profit, it's simply a past measure of how much excess cash a business should really highlight that, should be generating from operations. And so it's an accounting measure. And when we use accrual accounting, which that's kind of the gold standard of all accounting techniques, profit completely ignores the timing of incoming and outgoing cash. And the best example I can give there is in sales. So maybe you sold a product or a service for $1,000, but did you actually receive payment on that $1,000? If you're in a business that lets you let your customers pay later, your profit's actually not going to accurately reflect your cash flow, because it's going to show $1,000 coming in sales, even though you actually haven't received that actual cash. And it could be the case that somewhere down the road, the customer actually never pays you. And so you actually end up with $0 in sales. And of course, that reverses on an accounting basis, but that doesn't help you on your cash flow basis. So it ignores the timing of inflows and outflows. When you also think about it, when accrual accounting is used, it also requires accountants and bookkeepers to make estimates and, smooth amounts on the profit and loss statement to reflect ongoing business operations. And I know that not everybody does this, but it is common. And so what I mean by this is that you end up with things like depreciation. Like that's a very common estimate. It's for wear and tear on your equipment. Sometimes you do it each month, maybe you do it every year. But if you look at your profit and loss and it has depreciation on it, it's actually going to imply that there's a cash outflow, even though that there's not. So that can be confusing for people that aren't familiar with accounting nomenclature. It also means when I talk about smoothing, we end up with things like realizations. And I'm doing air quotes here, but my camera's maybe not big enough. So realizations are when you smooth out prepaid items, essentially, like annual insurance payments. It's very common for businesses to pay 12 months of insurance in advance unless they finance it. And technically what you're supposed to do from an accounting basis is record that each month that it's earned, using a lot of air quotes here, as it's earned over time. And what this does, if people are doing this on their profit and loss statement, is it greatly understates the expenses for the specific month when you actually paid that insurance bill, but then it overstates all other expenses for the remaining 12 months. And so, it's got a lot of interesting technical issues with it that, don't really relate to cash flow. You also have to keep in mind that profit is a measure of operations. And because of that, on an accounting basis, it doesn't include real world cash payments, like say principal repayments on debt. And that's because repayments on debt are actually a financing activity and they really take place on the balance sheet. And so the profit and loss doesn't actually contain all cash flow information. And of course, because profit is actually a past measure, meaning it only looks at accounting data that occurred in the past, doesn't consider anything that's going to happen in the future. A business might be completely profitable for years on end, and then get hit by a black swan event that completely changes their daily operations to the negative. And COVID is a prime example of that. Everyone's experience with COVID shows that lockdowns can affect people, came out of the blue. And so you can have profitable business affected by something that happens in the future and, completely throws their business model apart. So when you look at profit, it's manipulated, smooth, doesn't contain future information, and actually misses some actual other information in terms of the financial statements. And so when you think about it in this way, you can see how businesses that are solely focused on profit, and I'm not saying that everybody does, but a lot of people are focused on the profit and loss statement. You can see how they can get caught off guard with financial surprises. And you can then see how these same businesses could fail, even though they're profitable. And so this is where cash management comes into play. It can help in this situation. What is cash management? And I like to define cash management as the simple process of looking at cash inflows and outflows as they actually occur, as well as when they are expected to occur in the future, so that you as a business have a solid grasp on how much money will be in your bank account at any point in time now and into the near future. And so really, at a very high level, it's the opposite of profit in a number of different ways. When you're carrying out cash management, you really look at your bank balance today, but then you also consider how that will change as you collect receivables and future sales. And you'll also consider how it will change again as you pay your old bills, as well as new ones that come in the future. And then you also will be looking at what we call cash gaps, and how these might need to be filled in based off of your initial bank balance, AR, AP, and your future estimates. So cash management and using cash management, you're basically planning and managing your cash flow proactively. You're planning it in advance, as you expect. It's not saying it's perfect and 100% accurate in terms of what will occur, but you're going through the process of actively looking forward into the future and saying this is probably what's going to happen, so that you can then gauge your business operations appropriately. And as you do this, you're going to get a strong sense of the ebbs and flows of the cash running through your business, how payroll and debt payments can cause strains on your company if cash isn't collected on time, and how poor invoicing and potentially poor follow-up with customers can hinder operations just on their own. And of course, all of this information can be used in the three areas of cash flow that we talked about, the three levers, AR, AP, and short-term financing that solves the cash gaps, which ultimately helps you, if you can use that information and make decisions off of it, that will ultimately help ensure the success of your business and help you make better decisions. So, let's dig into the details a little bit more. When it comes to receivables and cash management, what do you need to be watching out for, and what opportunities can arise? First, you should be watching your AR timing. For cash-based businesses, this is obviously not a concern because there are no receivables. Cash simply comes in as sales are rung up. But for a very large proportion of businesses out there, they don't have this luxury, and if they aren't watching how their customers are paying, or more appropriately, how they're not paying, these businesses could be in trouble. So track how your customers are paying and know those that are good versus those that are bad. This will help you make more informed decisions as to who you want to work for in the future, especially as the amount of the sales invoices increase. Is it really worth taking on a big new contract if you know that customer is going to pay you extremely late, and that's going to stress your business in terms of its cash flow? Can your business even support that? You should also be thinking about how you can improve the timing of your AR collections. Could you provide different payment options so that your customers pay quicker and you can collect quicker? Are you sending out reminders to see if you can improve how quickly you can collect your cash? And you should also think about how and when you actually invoice your customers. It's in terms of cash management, when you're looking at receivables, you need to think of the whole holistic picture. So it's not just when am I collecting cash, but how quickly did you actually invoice the customer in the first place? Obviously, the quicker you can get those invoices out realistically, the faster you'll probably get paid on the back end. And of course, some of you might be thinking, why are we even talking about this? This is all pretty rudimentary. But these are actually the things that I see most glossed over by most small business owners. Typically, they're busy and they don't want to annoy their customers or come across as pushy. So these are the things that typically get pushed to the back end. And if that's the case, you're already short-circuiting your cash flow. And so from a cash management perspective, you want to have a really good handle on your incoming cash. And so handling your AR process and your invoicing process and your sales process holistically is extremely important. And so to the business owners out there, and even to the professionals, just remember that it's okay to get paid for what you created or did. Your customers are actually expecting you to invoice or bill you. That's why they went to you in the first place. So never feel bad about actually bugging them about getting paid. Outside of the timing, another key area to focus on when you're looking at receivables is how you're actually collecting payments. As we already kind of alluded to earlier, providing payment options to your customers might speed up the AR collection, but there's other areas that we can look at. A key question that I get quite a bit is, should I accept credit cards instead of cash? And this is really common for business owners, and I often see them shy away from it because of the 3% plus fees that credit cards typically charge, or more in some cases. But here, businesses really need to think about the ability to collect instantaneous payments and having cash in hand. It's typically more valuable than that fee charge that credit cards charge you. You have to think about how much time and effort it takes to follow up on late payments. And if you run the math, especially if you have, financing in place and interest charges based off that, the carrying costs of having accounts receivable on hand are probably higher than that 3% cost that credit cards or more are charging you. And in a similar vein to this, when we're looking at AR and how we could be collecting things or collection process in general, we should be thinking about providing discounts for early payments. This is a common practice for larger companies. If a company payable term might be 30 days, but if a customer pays earlier, they might receive a 5% discount, something to that effect. And again, think about it in terms of the whole process. If you walk through and calculate the carrying costs of accounts receivable, especially if you're carrying debt to essentially cover your accounts receivable over, say, a 2-month period or more, these discounts that are provided could be worth it and essentially could help you save money or your client save money. And of course, you can flip this around and say, well, should we also be considering charging late fees after a certain period of time to cover these carrying costs? And of course, you have to go through that same process and think about that. One last thing that I kind of like to point out in terms of accounts receivable and cash management and things to think about in key areas is those businesses that have progress draws or milestones in their payments. These businesses really need to think about how they're collecting from their customers. You know, best practice would be to ensure that your initial collection, your initial draw, your initial billing covers most of the cost of the project. And this will ensure that, you know, it increases the odds that the whole project can be completed without real risk to your actual business, which greatly improves your cash flow. Best practice would also say that you should try to collect this initial charge up front as much as you possibly can, you know, even before the project starts at all. And again, this ensures that you aren't out of pocket, you aren't stretched in terms of your ability to carry out the project, etc. And of course, where you can't do these best practices, make sure that you try and match your payments, your collections in line with your payables, because if you don't do that, then you'll be incurring additional expenses and carrying costs that just aren't necessary. So at the end of the day, what are some key metrics that you want to watch out for when it comes to AR? And, you know, we've kind of got two listed here that are pretty key, and these tie in with essentially what we were talking about, and that's receivables over 60. One of them is receivables over 60. When you talk to banks, banks typically won't lend you money on receivables that are over 90, and that's because they are considered uncollectible. Auditors, you know, whether they're a accounting firm or the actual government, they'll typically challenge you on those in the same way as bad debts, because that's how they view them. And so what that tells you is that if anything's over 90 days, you should really watch kind of how long they're hanging out there. And so you really want to make sure that you're catching them before they even reach there. So really looking at your receivables over 60 is really key. You also want to look at total receivables less total payables. We'll be covering payables next year, but rest assured, if you have a lower amount of receivables than you do of payables, you will be hitting some kind of cash shortage in some way, shape, or form. So you're going to need cash reserves on hand to cover that, or you know, figure out how you're going to cover that cash gap in another way. So when it comes to payables, in terms of cash management, what should a business be watching out for and what opportunities can arise? Similar to receivables, timing is definitely a key area. Most obvious reason for watching the timing of payables is, you know, the fees and the interest charges and the penalties associated with late payments. The more you cross that threshold, the more you're simply costing your business. But of course, in saying that, paying too early can also be an issue, because the sooner you pay your bills, the less money you have in your bank account. And this could mean that you might miss out on other business opportunities as they come up simply because of a lack of cash. That being said, paying too early can actually also have a physical cost to it. Again, if you are not collecting cash and matching the timing of collections and outflows as close as you possibly can, you could actually require some kind of financing to cover the shortfall, which means you're getting interest charges on that. And so, you know, those are considerations that you have to have as part of the cash management process, and how you can minimize those costs as much as possible based off, you know, your decision and your plan. And of course, in saying all that, the only way you can make any of these decisions is if you're actually getting the information into your accounting system as quickly as you possibly can. And so again, similar to accounts receivable, truly knowing your process at a holistic level is actually really important. You know, you should see if there's ways that you can speed up or improve getting that information into the system. So leveraging automated systems, bill payment systems, that kind of thing. Similar to accounts receivable, knowing how you pay is also important in payables management. You know, I always like to talk about checks because they're still very prevalent here in North America. Checks can cost people an average of $8 to $12 per check. Those are stats that are actually out there from certain companies. So if you utilize a lot of checks, you're actually spending a lot of money that you might not have to. So switching to automated bill pay systems could save you a lot of time and money over time. So of course, you can start using electronic payment systems. But here too, you got to watch what you're doing, because say e-transfers are quick and easy and a preferred method for a lot of people, but sometimes they carry a per transaction cost. So that means things like EFT or ACH batch payments can be a lot more cost efficient, or using online tools like Bill.com, Pluto, or Veeam, which can usually carry out payments on an even more cost effective basis. And of course, keep in mind that the physical cost of the transaction isn't the only consideration here in terms of cash management and best practices. You also need to take into consideration the time and the effort that the people behind the process are actually spending on all of this stuff, because that can sometimes be a much larger cost. Generally speaking, if you know what your cash position is and you're using efficient systems and your processes are all set up, you could start taking advantage of annual pay or early pay discounts. And so this is part of the knowing how you pay. If you have very good optics around where you're at and what you're trying to do, you can start saving more money as a business or for your client's business by taking advantage of some of these annual pay offers. So in the case of, say, insurance or software subscriptions, sometimes these discounts can be pretty substantial. And the more you do it, the more that's going to add up and the more money you're going to save. So key metrics for accounts payable: due dates. We kind of spoke to it pretty ad nauseum here, which is if you're paying close attention to your due dates, you're going to know if you're paying too fast or too slow, and then it will help you avoid additional carrying costs, interest charges, penalties, late fees. It'll help you save all of that money if you're monitoring it properly. And again, this is a prime example of things you can't necessarily track easily using profit, income statements, because you just simply don't have those same optics. And we talked about, at the start here, 3 different levers essentially of cash management: AR, AP. But there's also the short-term, what we're calling cash gap here, where you might need short-term financing. So what is a cash gap? It's a bit of a slang term that I use for any temporary shortfall or a large drawdown that you might have in your business's cash flow coming up. And if you are properly managing your receivables and your payables and estimating your future inflows and outflows, essentially a cash gap means there's not enough money in the very near term to properly sustain business operations for a short period of time. So a good example here would be that your cash position at the end of each month is always positive, but within the month, your payroll commitments always put your business into a negative cash position for a week or 2 until you start collecting cash again to cover those charges. Or on a longer term time horizon, it could be that your business is cash flow positive year over year, but within the year, seasonality could put your company into a negative cash position for a portion of the year. These are all cash gaps. And cash gaps can really only be filled in a few different ways. You can generate additional cash from operations, you can generate additional cash from selling assets, or you can generate additional cash from financing. You could also do it from investments, outside investment, but because this is a short-term situation, it's probably not likely that you'll go that route. When you look at operations, they usually can't be ramped up or down quickly enough or in a scalable way to solve near-term cash gaps. And so it's not really a great option. Selling assets is an option, but it's not likely desired because of the negative impacts it could have on your future earning potential, as well as trying to sell stuff in a distressed state is not necessarily the best in terms of maximizing your dollar value. So essentially most people, the third lever for cash management here is typically financing. And financing can take many forms. It could be credit cards, lines of credit, working capital loans, secured loans on things like inventory or receivables. Or it could be high interest loans that simply are unsecured and carry higher interest charges, or factoring or sales financing. And so cash management can really benefit here, as it will give you the opportunity to see these cash gaps coming in advance. And this is a huge advantage because the sooner you see that cash gap coming, the more time you have to pursue the lowest cost option. Excuse me. And when you're talking about some of these high interest loans, you can save a lot of money on them. Some high interest loans can be north of 30% per year. I saw one last week, I think, for 43%. So taking these on can lead to cash flow issues in of themselves, because they create essentially a vicious debt cycle where there's so much money going out in terms of interest that you can almost never catch up. So this is where cash management can really help businesses in terms of just managing those cash gaps and making sure that businesses are running extremely efficiently and streamlined. So we've gone through cash management at its core conceptually and talked about a lot of benefits and cost savings and things that you could do in depth. But it begs the question, how do most businesses carry out this process right now? And typically it's pretty disparate. It requires a lot of different tools. You have accounting software to check and code invoices and bills. You're using that same software to probably produce reports that you need for your spreadsheets. You could be using banking software to make payments, or you could actually be making those in person using checks, or you could be using payment softwares to pay those bills, and you could be using spreadsheets to forecast, plan, report, and aggregate the data and manipulate it all. And so lots of different tools here. And the interesting part is also that as companies grow, each of these areas could actually be handled by a person in of themselves. So you end up with a lot of disparate processes and silos in terms of the actual cash management process. And to speak to that, on top of the tools and the people, because of the amount of tools and people that are involved, there's a lot of conversations that have to be had in cash management. Again, we alluded to this at kind of the start of the webinar. It's one of the reasons that we believe that the cash management process can never really be fully automated. There's no way that a machine can know what's in a business owner's head in terms of future information and possible decisions. And the communication process itself requires a lot of back and forth between multiple people. It requires checking a lot of different systems. It requires inputting data into spreadsheets, emailing questions to different people, running models again after answers are received to those questions, and then repeating that over and over and over again. And that essentially takes a lot of time. So of course, that's essentially why we built Helm. Those are all the pain points that we started out with. So Helm simplifies the cash management process by bringing data into one spot. It also integrates a number of different tools used in the cash management process to make it faster and easier. And it also provides a platform where people can collaborate in real time on the cash flow forecasts, which eliminates a lot of the pain points in terms of the communication process and getting context again for these business decisions. Again, having discussions around what is happening is a key piece of the cash management process. And so it needs to be handled quite efficiently. So I'm running a bit long here, but I will now hop into what Helm looks like and can show you some of the features and how they would relate to cash management. Just give me a sec here to load up.
And maybe while you're getting set up, Kelvin, if anybody has any questions about any of the content or comments, please go ahead and pop it into the Q&A section.
All right, just bear with me here. All right, I got some notes here, and I'm going to try to cover as much as I possibly can in about 6 minutes. So we'll walk through it at a very quick level about what you're seeing here. So this is Helm. This is pre-built data that we pulled out of an accounting system. It's overly simplified. But what you're seeing here at the top of the page is your bank account balance over time. So if you see here, we can see exactly where this company's bank balance is at any point in time in the next 3 months. And then at the bottom of the graph, we can see transactions coming in. There's a zero line here. Transactions coming in are above zero, and transactions going out are below zero. So it's a very visual tool that was built to be easy to digest and understand. Again, going back to a lot of the processes and disparate systems that you have here in cash management process. And again, keep in mind that the cash management process requires us to know our bank balance, which you can see here in Helm. It requires us to know our existing accounts receivable, which you can see here in Helm, your accounts payable, as well as all future inflows and outflows. And so you can see all of this information here in one place. It's really easy to access. I don't have to go to any accounting system and open up other AR and AP reports. All the information is here. I don't need to open up a spreadsheet and manipulate it. Our accounting data is tied directly into Helm through integrations, and it's calculated and automatically updated for us as the accounting system updates. And I can easily make any changes to my future estimates using the forecasting rule drawer here that I'm sitting in. And so this makes managing, planning, and collaborating much, much easier in the cash management process. You're not jumping around to different systems. Everything's in one spot. You can easily visualize it, see it, plan it, talk about it. And so let's talk about the AR specifically. When we were talking about AR initially, we said one key piece was timing. So part of the cash management process, the key piece of that is timing. We have features here in Helm that speak directly to that. We have a calculation called ADR, which is average days receivable. That is calculated by the system based off your accounting system, based off your accounting information about how quickly people pay you. So Ridgeway University pays in 48 days, and this is based off their past transaction history. This gives us a lot of information in terms of how people pay. So again, this is demo data. It's not fully populated, but there could be 30s, 15s, 90s. There could be any information in here depending on how our customers pay. This is a really good way to essentially risk assess our customers, and the higher the ADR, the slower they are to pay, the more risky they are, especially if they're large invoice amounts. But you don't just have ADR, you can also look at just typical age. And so here you can switch to the age view, and we can see exactly how outstanding our existing invoices are. So we can see here that City of Limousine obviously pays pretty slow because we have some 63, 46, and a 43. And again, this 60 mark is a key metric, because if it's over 60, you're starting to run the risk that it's getting to 90, which means it's starting to become uncollectible. So with a quick switch, we can look at age and see exactly where our outstanding customer payments sit. Of course, we can look at other information. If we want to actually look at amount, we can sort this table very quickly. Again, we don't have to hop into other systems and look at our biggest receivables. And so we can see here that Ridgeway University is our biggest. It's also very apparent on the graph, but it's easy to pick out here on the list. And we can also even update it with color, just so that it kind of drives home the point that this is maybe something that we want to look at. We can do all these same things in accounts payable. And so you can see in the accounts payable drawer, everything's in one spot. I don't have to go into another system to pull a report, look at it, get information on it. It's all here just by a click of the button. Again, much like accounts receivable, we have the concept of ADP, which is average days payable. So this is how long it takes us to pay people. And we can see here that we pay NetConnect in 9 days, Power Direct in 10 days, Swanston Security in 6 days. So this gives us a lot of information about how we typically pay, which could be useful in the decision-making process. Similar to accounts receivable, we can look at age. So 54 and 52 days outstanding here. If Central Copiers has due date terms of 30 days, we definitely should be paying this bill. This is an issue. Again, much like the accounts receivable, we can color these invoices if we want to, just to help highlight information. We can do that through bulk editing up here, and I'll change these colors to purple just for fun. So you can see those two invoices here and here, bills, I should say. So you can see your accounts receivable and your accounts payable very easily. And really what that allows us to do is play with it quickly. And so this really speaks to cash gaps. So you can see it right here. I'll just close it so it's a little more apparent. This company is in a negative cash position right now. And it's because Smart Agency invoices here, and we are trying to pay too many bills today relative to our cash position. So this is a highly simplified demo, just given time constraints that we have, but I know that Smart Agency probably is going to get paid earlier, and I can drag and drop it or change it through the AR tab to where it would be. And then I can say, okay, I actually want to pay these Smart Agency bills when I receive that Ridgeway University bill. And hopefully that will solve the cash gap, which it does. So you can see some very simple planning, our cash is now above the 0 threshold. So that is cash management. We looked at our AR. There was some assumptions around when things are being received. We looked at our AP and kind of how that was working. And we've adjusted it to what our expectations are of reality, and essentially solved the cash gap by delaying some bills. And of course, this is under the premise that we are allowed to do that with Smart Agency. That would require some discussions and this, that, the other. But you can see the overarching goal here on how easy it is to manipulate the information and come to a conclusion. And so if you tried to do this in a spreadsheet, it would take a whole lot more time. You can also create scenarios. And so this kind of adds to the whole playing feature of the data. And we'll just surface it really quick here. We'll create a new scenario. And we'll see what impacts things have when we start playing with other data. So here, let's say that PC complete can be pushed out to a longer date, just like the Smart Connect bills. And so maybe here we'll say gets paid on August 25th. And let's maybe say that our advertising estimates are simply too high. Maybe they're actually $300 per month instead of $612. And so again, this is an overly simplistic example of what you can do with Helm, but you can see very quickly that based off those changes in our payables, as well as the long-term impact on our budget estimates, you can see exactly how that impacts your cash based off your base case scenario or your as is scenario. So it's a very powerful tool for helping you plan, think, go through a lot of different conclusions and help you properly manage your cash position in advance. And again, that's the whole point of the tool. You know, we're not looking out 3 to 5 years in strategic. We're actually saying, we don't want to get hit by any buses. So let's look out in the near term here. Let's look on the street and make sure that we don't get hit by any buses. So in that same vein, I'll just have to switch back to, sorry, my base case here. We built Helm to be very efficient and very seamless in terms of the cash management process. You can kind of see that through the examples that we've just walked through. But in terms of accounts payable, you know, again, we've integrated this system with other tools to help take the load off people on the cash management process in general. So it's not just the planning and the decision making, it's also the execution of the actual cash plan. So if we assume that our base case here is good, it is what we want to pay, we can actually pay these bills directly through Helm using our integration with Veeam. To do that, you would actually need to go into your settings. You would need a Veeam account firstly. And this one wasn't set up on a demo company, so I do apologize. There is usually a Veeam integration button here. So I would click that. It would connect my Veeam account with Helm and then give me the ability to create payments in the account. And that payment process is as simple as this. This is my AP plan, and I want to pay these 2 bills on August 5th. And it looks like this demo company changed based off what I was working on. There is a pay now button that shows up here, which you click that, and then that allows you to pay the actual bill here. gotta love live demos in terms of how it works. And so my setting is incorrect in terms of how I set this up. So I do apologize, but there is a pay now button here, which then you go through the process of, entering information in for the suppliers in terms of where to send the bill, their address, the purpose of payment. So there's a little bit of upfront time that needs to be sent in terms of setup, but once it is all set up, it saves a ton of time and effort in terms of ongoing maintenance costs. So it seems a little bit simplistic, or maybe trivial, but the reality is that paying bills directly out of Helm saves a ton of times in terms of trying to coordinate that with your clients or other people in your business. It saves a ton of time in terms of going into other systems. And I always like to say, minutes turn to hours, hours turn to days. And so that's what we're trying to save here. We're just trying to save the time and effort in terms of people's payable process. So I'm trying to be cognizant of time here, so rushing a little bit. I do want to leave a little bit of time for questions and answers here at the end. But here is another tool that we use to help the cash management process. This is a scorecard that we've built that reads all the information in your cash flow forecast. And at a very high level, this scorecard helps you manage your business, helps you manage your cash flow. It will tell you certain metrics that are very important in terms of cash flow. And we've got information on our website about what these measures actually are, or you can reach out and we can kind of help guide you through it. But the whole point here is that it actually scores your business and how well you're doing. If you're orange, you're doing okay. If you're red, you're doing bad. And if you have a green bar or a very high score out of 100, you're doing very good. And it breaks that down by the actual metric that it measures. It also provides you a little information in terms of how you can improve it based off kind of industry parameters and where things should be at. So it also helps kind of guide you in terms of things that you can work on as a business to improve your actual cash position. So it is 10 minutes to the hour. So I will leave it there and actually flip it back over to Laura, and that is the end of the demo. So I do apologize for taking a bit longer than I expected there.
Thanks, Kelvin. I just wanted to find out if anybody has any specific questions or have any comments in terms of what Kelvin presented today. I know a few people use Helm now, and a few people probably are using spreadsheets for cash flow management. Did anyone have any questions on some of the tips? Okay, awesome. And I believe that we have just gonna go. Just give me 1 second here. I'm not sure if I'm in the right spot here, so just give me a second. Still don't see any questions, so. Yeah, I'm not going to be able to get this presentation up for some reason. Okay, I'm just going to do a quick summary then. So we covered a little bit about using Helm. Oh, thanks, Kelvin. I guess the big question is, hopefully you were happy that you signed up and took the time to join us. Maybe people, if you just want to raise a hand, hopefully you feel like you have a better understanding of how Helm simplifies cash management beyond what you knew before. I'd love to see at least one hand go up to make us feel like this was valuable. Yay. Thank you, Dorothy. That's awesome. That's great. If anybody would like to know more about getting started, Kelvin, if you could move to the next slide for me. So for people who are not using Helm or haven't tried it before, you can certainly, if you've done a trial and you're not actively using Helm, you can sign up again. Normally our single business account is $49 a month, but what we'd like to do is offer a 25% off all subscriptions for the next 12 months. So there is a question here, and we will get that to you in a second, Megan. So because you signed up today, what we'll do is, if you have an active Helm account by the end of July, you will see a 25% discount applied to your subscription. That is including people who already, and I think I see at least one person who I know is an active Helm user. It will be applied to yours as well, as a thank you for joining us. And if you want to get started on free trial, just go to takethehelm.app and go into free trial. If you'd rather have a demo, just schedule a time to meet with us and we can talk a little bit more about your unique needs. And then Megan had a question. So Helm does not factor in purchase orders, just bills, correct? And
yes, that is correct. So at this point in time, purchase orders are a little bit interesting because depending on how people use them within the business or as a firm, they can sometimes be more of an estimate than an actual purchase order. And so we have defaulted to using just bills. So I know your question is going to basically be around, can I forecast based off purchase orders? So it's not a possibility in Helm at this point in time.
Mm-hmm. But Kelvin, it can be, like, for example, because forecasting rules are often quite a lot like using a spreadsheet. If you kind of know, like, this is a firm order, and you know that it's going to happen in October, you can go ahead and pop it into your forecasting rule to actually make sure that you're accounting for it. So this is where that context piece that Kelvin was talking about comes into play, right? So if a client says, this is a firm order, it's okay to put it into the forecasting rule. It won't change anything except for the knowledge that that money will be coming in and the line of sight that it will be coming in and can be used.
Yeah, that's 100% correct. And it's a very good point to point out. You could definitely handle it in the forecasting rules. That's why we built Helm the way that we did, so that it's simple and easy to make changes like this and adjust them. Because in the case of purchase orders, maybe it needs to be delayed or changed in some way, shape, or form. You can easily adjust that in Helm to make sure your forecast is correct. So hopefully that answers your question, Megan.
Any other questions? Okay.
Perfect. Well, are we going to call it a day then and give people 3 minutes of their time back? That's actually really good timing. I think you're actually muted now. Either that or my speakers don't work.
No, that's me. Yeah. Thank you everyone for joining us today. Really glad that you were able to attend, and please send us feedback. Did you learn something new? If you think about a question, as soon as we shut down the session, just talk to us. We're here to help.
Yes, thank you very much for everybody attending. And if there's any other topics that people would like to learn about too, let us know that as well, because we always like to try to give people as much information as we possibly can. And thank you, Marilyn.